Welcome and wish everyone a very happy new year. 24 was a year which saw a continuation of healthy global growth, with inflation being broadly in control. As was expected, global monetary policy eased during the year, and this is expected to continue in a graded manner in 2025. In fact, a broadly more accommodative monetary policy might be the biggest support to growth in 2025. Closer home, macro stability has persisted and should persist in the coming years as well. Thus, in 2025, we expect the twin deficits and inflation to be range-bound and under control. However, the later half of 24 did see a slowdown in domestic growth rates of both GDP and corporate earnings from the preceding years. As we enter into 2025, policy direction and a few developments is what we will watch for. Policy directions would include, number one, the quality of contraction of the central government fiscal deficit. We expect growth in government infrastructure support to be modest in the coming year. Number two, the extent of accommodative monetary policy adopted by the Indian Central Bank. Number three, the actual direction of global tariff policy under the new US President and the US Fed reaction function. There are well-justified hopes currently about a revival in the growth rate of the domestic economy and corporate earnings. Amongst the developments we will keep an eye for are, number one, consumption in the rural economy. We believe the rural economy should do better than it has in recent times and support consumption growth. We will also watch for a pickup in urban consumption across categories which have been subdued in recent times. Number two, private capex and real estate cycle. We will watch for strength in the private capital expenditure and its contours. On the other hand, we expect continued uptick in the real estate cycle. And number three, asset quality of the banking sector. In a base case, we expect asset quality to hold up well in the coming year. We think asset quality challenges in some pockets, such as microfinance, will normalize in 2025. After a strong rally starting in the first half of 24, the markets consolidated in the second half, and this has led to valuations, especially in the large cap, coming closer to the mean. While we cannot rule out more volatility, this is a comfortable starting valuation for investors with a longer-term investment horizon. In the immediate term, the strength of the earnings trajectory will determine the strength and direction of the market movement. Over the longer term, we are confident that earnings growth would have revived into a double-digit trajectory. Additionally, the dynamics of the market remain healthy. On the one hand, we have FIs who have been sellers, and on the other, we have the domestic mutual funds and institutions who have been buyers. The markets are healthy because we believe major corrections in the market could be bought into by the FIs. In fact, in recent years, while India's share in the emerging market MSCI index has moved up by 8 percentage points to around 20%, in this period, FI have been sellers and their ownership of Indian equities has decreased by over 3 percentage points to being the lowest in a decade. On the other hand, domestic buying has led to equity share of household savings rising from less than 3% to around 7% in this period. To match the increase in domestic demand, we have been seeing an increasing supply of equity paper through IPOs, FPOs, promoter and private equity stake sales. Going forward, the productive utilization, especially of funds raised by the corporates, will further determine the corporate earnings growth outlook. We must reiterate that structurally India's growth outlook remains robust. Thus, this will be led by a judicious combination of favorable demographics, capital availability, and improving productivity and efficiency gains. The Indian markets offer investors an opportunity to participate in the same and, most importantly, benefit from the power of compounding. As in recent years, we cannot rule out the possibility of completely unanticipated events and would also recommend investors to follow a prudent asset allocation approach. Once again, wishing everyone a very happy and a very prosperous new year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.